Well, good afternoon, ladies and gentlemen. In the space of less than an hour, I'm going to attempt to give you an introduction to a subject that is almost as vast as it is vital, namely money. What I will tell you is what money is, and then what its existence makes possible. I will explain how money came into existence, and why gold in particular came to be money. I will give you a statement of the quantity theory of money and indicate its great explanatory value in understanding the subject of inflation and the growth of monetary aggregates, such as so-called gross domestic product, GDP. I will explain why, under economic freedom, gold would almost certainly become money once again, and how such a monetary system would serve as a powerful check on the expansion of government and would operate to prevent inflation, and in its pure form, known as a 100% reserve gold standard, would operate to totally prevent deflation and depression as well as inflation. I will indicate how the abuse of money through government interference is what is responsible for the problems of inflation and deflation and the closely related boom-bust business cycle. This interference includes the government sanction and sponsorship of dishonest behavior by private banks in the form of credit expansion, that is, the granting of loans out of newly created money. I will indicate further consequences of the government's abuse of money through inflation, namely not only its own unchecked growth and the business cycle, but also capital decumulation and the consequent undermining of the productivity of labor, the arbitrary redistribution of wealth and income, and worst of all, the potential total destruction of money and all that depends on it. As to the remedy, that will be the subject of my class on the path to sound money on Saturday. On Friday, in the economics of inflation, I'll deal with the nature and consequences of inflation in greater detail, especially showing why inflation is the government's increase in the quantity of money and not at all rising prices in and of themselves, and how this proposition is actually supported by the opposing theories. Well, let us turn now to what is money. Money has been defined as a generally accepted medium of exchange. In simple language, it's a good that everyone in a society is willing, indeed eager, to accept in exchange for his own goods or services. And once they obtain money, people subsequently use it in order to re-exchange it for the goods and services of others, who are just as eager to accept it from them. To all appearances, it seems that everyone is willing to accept money in the conviction that everyone else is willing to accept it from him. And now for the importance of money. However it is that money comes into existence, the fact that it does exist is enormously beneficial. Without it, the division of labor society on which modern material civilization rests would not exist, could not exist. A division of labor society is characterized by the fact that each individual lives by producing or helping to produce just one, or at most a very small number of things, practically all of which are consumed by others. At the same time, almost everything that any individual consumes in such a society is produced by the labor of others. Just think of any job that you may have had and how specific was the nature of that job and who ultimately physically benefited from its being done. If, for example, you worked in a button factory, the physical beneficiaries of your work were the people who got those buttons on their shirts or whatever. Then think of all of the kinds of work that are done by other people in producing all the things that you consume, from automobiles and air conditioners to products containing zirconium. Among the benefits of a division of labor society is the fact that the volume of knowledge employed in production is radically increased. Instead of everyone living as a self-sufficient farmer and having the same meager knowledge pertaining to production, the volume of knowledge employed in production comes to reflect the combined bodies of knowledge of all the different specializations. And every individual benefits from this radically enlarged body of knowledge in his capacity as a buyer of other people's products. A division of labor society would not be possible in the absence of money. In the absence of money, goods and services would have to be exchanged in barter for other goods and services. The producer of each good or service would have to find some way of exchanging the specific good or service that he produced for all the goods and services he desired from everyone else. For example, the producers of sulfuric acid, ball bearings, steel girders, computer chips, haircuts, and whatever would have to find some way of using their goods or services in exchange for food, clothing, and shelter. But how many grocers or farmers, clothing stores or clothing factories, landlords or mortgage lenders have any need for such goods, especially on any regular or reliable basis, and from any specific such supplier, such as this or that particular barber or other supplier? Also, how could the producers of such valuable, indivisible goods as automobiles or houses use their products in exchange for goods of such small value as a loaf of bread? They could not break off a piece of a car or house and exchange it for the loaf of bread. In these and practically every other instance, a tremendously complicated and onerous process of indirect exchanges would have to ensue, such as perhaps exchanging computer chips for computers, exchanging computers for flour, assuming one could find a flour mill that needed computers at that particular time, and then exchanging flour for bread, assuming one could find uses for a truckload or warehouse full of bread. Ultimately, one would need to assemble all the varying collections of goods that would satisfy one's various employees, one's various business suppliers, and one's various personal suppliers, all of whom in turn would almost certainly be under the necessity of engaging in further complicated series of exchanges before they could obtain goods and services they actually wanted. Frequently, it would simply be impossible for people to obtain the goods they needed. And when it was not impossible, it would be extremely costly, although no one would be able to know just how costly. For another closely related problem would exist in the absence of money. Another closely related problem that would exist in the absence of money would be the inability to calculate costs, with the result that no one could know whether or not his operations were successful. The computer chip manufacturer, for example, started out with so much silicon, such and so much chip-making machinery, and so forth. And now he's used up his silicon and part of the useful life of his chip-making machinery and ends up with a certain quantity of computer chips, or if he exchanges them, bread, or a variety of goods for which the bread can itself be exchanged. How could he possibly know whether he'd gained or lost by virtue of his activities? I'd like to observe here, incidentally, that precisely such ignorance of gain or loss exists in a socialist society, which, as von Mises demonstrated and several of the previous lecturers have alluded to, also cannot calculate costs. In the absence of money, the only reliable means of obtaining life's necessities would be either to attempt to produce them oneself as a farmer, or to produce goods or services of the kind farmers frequently needed. For example, be a blacksmith or a country doctor. But that would mean the destruction of the highly productive specialization of the modern division of labor economy and the loss of all manner of goods and services vital to a modern standard of living. The result would be dreadful impoverishment and mass depopulation. The existence of money prevents these problems. Because of money, it is not necessary for a producer to produce what any of his particular suppliers may want. It is only necessary for him to produce something that anyone, anywhere in the world wants, who is able and willing to pay money for it. Because once in possession of money, that producer is able to turn around and buy from anyone he wishes. Because as we have seen, money is something that everyone wants. In this way, the existence of money radically widens the extent to which the division of labor can be carried. We don't have to produce what our suppliers want. We produce anything that anyone wants who's able and willing to pay money, and then anyone that we want something from will be delighted to accept money from us. And it's in this way, I say, that the existence of money radically widens the extent to which the division of labor can be carried. At the same time, money provides the intellectual basis for the conduct of a division of labor society. Because of money and the existence of money prices for all goods and services, producers are able to compare money revenues with money costs and know whether or not they are producing successfully. In a monetary economy, our computer chip manufacturer, for example, knows the money cost of his silicon and chip making machinery and the money value of the chips he produces and sells by virtue of using them up. Assuming that the buying power of money has not significantly fallen between the time he purchased his means of production and the time he sells his product, a money profit signifies an increase in his ability to obtain goods and services in exchange from others, and thereby marks his operation as successful. Closely related to this, the existence of money prices makes it possible to compare the costs of using different methods of production and to choose the most economical. It makes it possible to compare the profitability of producing different products and the profitability of investing in different branches of industry, and to compare the remunerativeness of working in one occupation rather than in another. Both by radically enlarging the extent to which the division of labor can be carried and by providing the essential guiding intellectual framework for its conduct, money makes possible modern material civilization. So far from being the root of all evil, it would be far more accurate to describe money as an essential foundation of all that is good in the material world. I turn now to the question of how money originates. Money originates in the conditions of barter. It originates by virtue of people seeking to exchange goods of what Menger calls lesser marketability for goods of what he calls greater marketability. The exchange of computer chips for computers in our previous discussion would be an example of such an exchange, on the assumption that more people are ready to accept computers in exchange for their goods or services than are ready to accept computer chips. To the extent that this is the case, obtaining computers in place of computer chips would make it easier for the chip manufacturer to obtain the goods and services he ultimately wanted. At any given time and place, some goods are more frequently desired by more people than are other goods. For example, even now, cigarettes are very widely desired. Certainly they are desired by far more people and with far greater frequency than is one's old typewriter. In the absence of the existence of money, it would make sense for the owner of such a typewriter who wished to exchange it for food or medicine, say, to exchange it for cigarettes, even though he personally did not smoke and perhaps personally abhorred smoking. This is because he would be more likely to find someone in possession of food or medicine who would take cigarettes in exchange for them than he would be to find someone prepared to accept his old typewriter in exchange for them. The principle here is that starting with some good possessing greater marketability on the basis of its use as an ordinary commodity, a new and additional demand for it emerges based on that fact. This new and additional demand serves to make the good even more widely and easily marketable than it was initially. In our cigarette example, the number of people ready and willing to accept cigarettes in exchange for their goods and services now includes not only the original core group wanting cigarettes to smoke, but a further group consisting both of smokers and non-smokers who want cigarettes for the purpose of re-exchanging them with those who wish to smoke them. The market does not distinguish between the motives of those willing to accept a good in exchange, and to any observer, it will now appear simply that cigarettes are more widely acceptable in exchange than before. This, of course, increases their usefulness as a medium of exchange and can thus serve to further increase the demand for them as a medium of exchange. The ultimate limit of this process is that everyone ends up willing to accept cigarettes in exchange for his goods or services, and after a while it appears simply that everyone accepts cigarettes because everyone expects everyone else to accept them. But the truth is that the initial foundation is in the good's greater marketability as an ordinary commodity, and then it builds upon itself with a series of layers of growing demand. Well, the growing demand for a good for use as a medium of exchange, the demand which will render the good money once its use as a medium of exchange becomes general, this demand serves to raise its value. In the case of cigarettes, it's entirely possible that if their supply were sufficiently limited, the rise in their value would be so great as to deter even the most ardent smokers from smoking very much, for then they would be smoking valuable money. If that were the case, the appearance of paradox would take on a further aspect. Not only would it appear that everyone accepted the monetary commodity simply because everyone else did, but also that the monetary commodity had no significant physical uses. Well, these considerations apply to gold, the actual money of the world for many centuries. Gold is by no means a commodity with merely trivial physical employments. When properly alloyed, it can be made to do most of the things that other metals, such as lead, copper, or even iron, can do. And it has unique properties as well, some of them of great use in the most modern technological applications. However, gold is very rare in nature, much rarer than most other metals. The combination of its utility and rarity establishes a high value, a value high enough to prevent the use of gold for purposes that can be served by other more abundant metals, and limit its use to purposes that require its more or less unique properties. The very existence of a high value of gold, based on its use as a physical commodity, serves to create additional uses for it. One such use is the giving of objects made of gold as gifts, expressing high esteem for the recipient. The same point, of course, applies to other goods combining high value and great beauty, such as diamonds. This additional demand serves further to increase the value of gold and to make it still more suitable for expressing one's esteem for the recipient of a gift. The second and potentially much more important new and additional use for gold is that the high value of gold can create the use of gold as a store of value, a store of purchasing power. That is, something which one saves in order to have the means of buying in the future. I believe that this use, usually described as gold's use as a store of value, directly underlies its development into a medium of exchange. Now, Menger and many other Austrians, of course, believe that the use of gold as a medium of exchange precedes its use as a vehicle for saving. I'm holding the opposite here. Certainly the potential for gold developing into a medium of exchange on the foundation of its use as a vehicle for saving, the potential for its development in this way was very well underway here in the United States in the 1970s and could occur once again in the future anytime inflation comes to be widely perceived as a great and growing threat in this country. Inflation destroys the value not only of fixed income investments, such as bonds and life insurance policies, but also the real value of stocks and family businesses. It undermines all business investment. It does so by virtue of the fact that it both artificially boosts business profits and at the same time the replacement prices of the assets which are used up in earning those profits. with the result that the far greater part of the additional profits is required for the replacement of assets at the higher prices. However, the additional profits are treated by the government as ordinary income and are thus largely taxed away, which makes the funds available for the replacement of assets insufficient. In this way, and in other ways that I'll discuss in Friday's class, the economics of inflation, inflation undermines capital accumulation and brings about actual capital decumulation. I believe that this effect of inflation was largely responsible for the creation of the so-called Rust Belt throughout the Midwest of the United States. In circumstances in which inflation renders all the normal forms of investment open to most people unprofitable in real terms, people turn to inflation hedges, to things that they can buy and hold whose price can be expected to rise more or less in line with the general run of prices, and thus leave them with at least substantially undiminished buying power rather than actual losses of buying power. Gold is the ideal inflation hedge for most people. As a metal, it will not die or rot, as will animal and vegetable products. And as a precious metal, representing great value in small bulk, its storage costs are low. For example, even now, 1 ounce of gold represents the same buying power as perhaps a ton or more of iron, a fact which results in a radically lower cost of storing buying power in the form of gold rather than iron or other base metals. The fact that as a metal, every ounce of gold of the same fineness is a perfect substitute for every other such ounce, and is also divisible and recombinable, gives gold important advantages over precious stones as an inflation hedge. In any case, in the 1970s, the growing demand for gold as an inflation hedge was in process of making gold a good desired by a group of people comparable in number to cigarette smokers. The existence of a group of people that numerous who would be willing to accept gold in exchange for their goods or services in order to add it to their holdings in provision for the future would have had the potential for making others willing to accept gold in the conviction that they could re-exchange it with those eager to save gold. As in the case of our cigarette discussion, the potential would have existed for everyone becoming willing to accept gold in exchange, and thus for a spontaneous remonetization of gold. I believe that gold originally became money on essentially this kind of foundation, namely its advantages as a store of value, and that's how it displaced such things as earlier iron coinages. Now, I want to note, incidentally, that von Mises was very eager to see the process of growing gold ownership continue and firmly opposed all impediments to it. His reason, which I fully share, is that the worst conceivable threat posed by inflation is the destruction of money, however remote this possibility may seem at the present moment. For reasons indicated in our discussion of barter, that would destroy the division of labor and thus modern civilization. But wide gold ownership would provide the foundation for the rapid replacement of paper money with a new gold money and thus prevent inflation from resulting in the destruction of money as such. Well, I turn now to the quantity theory of money, which I consider to be one of the most important propositions in all of economics. The quantity theory of money can be understood as the proposition that the quantity of money that exists is the major determinant of the amount of money that is spent. To illustrate this proposition, recall some old Western movie that you may have seen late at night, featuring some bedraggled old prospector. Imagine that he finally strikes gold, digs enough gold nuggets out of the ground to fill a small pouch, and heads off into town. His new and additional gold will be physically manufactured into new and additional gold coins, which he will spend in buying supplies and such things as rounds of drinks at the local saloon. The recipients of that spending will in turn re-spend that new and additional money. The recipients of their spending will do the same, and so on ad infinitum. The result is that the new and additional money serves to permanently elevate the level of spending. So long as the new and additional money remains in existence, the volume of spending in the economic system will be correspondingly larger. The quantity theory of money, of course, applies to every money, irredeemable paper money as well as gold money. Today, new and additional money comes into existence not by virtue of someone digging gold out of the ground, but by virtue of the government manufacturing new money out of thin air. Imagine the government has to send out $1 billion worth of Social Security checks. It's running short of funds. It creates $1 billion worth of new government securities, sends them over to the Federal Reserve System. The Federal Reserve System creates a new checking deposit for the Treasury of $1 billion, and now the Treasury can mail out $1,001,000 Social Security checks. Well, what do the recipients of the checks do with them? They could go to their banks, cash them, then they're spending cash. The cash passes from hand to hand just as the gold, or they deposit them in checking accounts. They write checks. The recipients deposit the checks in their checking accounts. They write checks. It's the same essential process. More money in existence supporting a larger volume of spending. Now, we have to hold in mind that a system of irredeemable paper money such as we have today can come into existence only on the foundation of a pre-existing commodity money such as gold. It begins as paper that is not irredeemable, but rather fully redeemable on demand for gold. Without this foundation, it would have no greater chance of being accepted than would the paper money from the game Monopoly, because it would lack a pre-existing recognized exchange value. However, once enough time goes by for a generation or more of people to grow up with the constantly repeated experience of redeemable paper money being eagerly accepted in exchange for goods and services, and observing little or no actual day-to-day use of gold coin, the demand for money is transferred to the paper money. In such conditions, the demand for paper money may not be greatly reduced, even though it then loses its convertibility to gold. In the United States, the day-to-day use of gold coin had virtually disappeared by the time of our entry into World War I. What was responsible, most of all, I think, was the National Bank Act of 1863, which for the first time created a uniform national paper currency convertible into gold. This took away the need of people to actually carry physical gold. I must point out that the increase in the quantity of money and the increase in the volume of spending that it fuels is the only factor that explains the growth or continuing growth in monetary aggregates, such as aggregate consumer sales revenues, which can be taken as a rough approximation to gross domestic product, GDP, and the aggregate value of business assets, and the aggregate value of outstanding securities in the economic system. The reason the stock and bond markets today are worth so many trillions, while not so long ago they added up only to so many hundreds of billions, that's because we have so much more money in existence. In the absence of the increase in the quantity of money and volume of spending, all such monetary aggregates would tend to stabilize. Increases in the physical volume of goods produced and physical assets accumulated could certainly continue at an undiminished or even a more rapid rate than would otherwise be the case, but the result would be correspondingly falling prices and falling unit costs. I turn now to gold as the proper kind of money. An essential difference between gold money and irredeemable paper money is precisely the rate at which their quantities can be increased. Gold is rare in nature and must be laboriously dug out of the ground, almost always at considerable cost. Paper money can be produced at hardly any cost and in virtually limitless quantity. If the production of paper money were subject to the freedom of competition, with everyone legally free to manufacture it, just use the proper quality paper, the proper drawing, and so forth, such a money would quickly become valueless. Having no greater cost of production than goods like paper clips, pins, or rubber bands, and capable of being expanded in supply just as easily, it would have no greater exchange value than they. Just as now it takes millions of pins to equal the value of an automobile or a house, so it would very soon take millions of paper dollars. Indeed, billions and trillions of paper dollars. For the manufacture of $10, $100, and $1,000 bills is no more costly than the manufacture of $1 bills and can just as easily be expanded. Indeed, under freedom of competition between irredeemable paper money and gold, the rapid depreciation of the paper would cause it to become altogether valueless. The demand for paper money would fall to zero as people sought the growing alternative of a gold medium of exchange, which would develop not only as the result of gold's growing use as an inflation hedge, but also because people with sums of money to be paid to them in the future would more and more choose to have those sums payable in gold, whose purchasing power could be relied upon. This development would make gold all the more acceptable in exchange because people with debts or other contracts payable in gold, such as a lease, would be eager sellers for gold to obtain the means of meeting their gold obligations. Just imagine, suppose you had a choice of how your pension is going to be paid. In today's paper dollars, the value of which will be determined by the actions of the Federal Reserve Board or some physical amount of gold, which they cannot do too much to destroy. Well, if people got their pensions payable in gold, then those who had to pay the pensions would be under the necessity of earning gold, so they'd be ready acceptors of gold. And similarly, people who had lease obligations in gold. So this is how gold would also become the actual circulating money. Now, in such circumstances, the only way that paper money could remain in existence would be by being made securely redeemable on demand in gold. For it would be gold with its stable, indeed increasing buying power that people wanted, not irredeemable paper with its rapidly falling buying power. What stops the triumph of gold, the obvious money of a free market, is the fact that we do not have a free market in money. On the one hand, the government makes the issuance of irredeemable paper currency its monopoly privilege. Its manufacture by anyone else is called counterfeiting and is punishable by law. This serves to restrain the rate of increase in the quantity of money. The increase still continues, of course, and is still far more substantial than is the increase in the supply of gold, but it does not reach astronomical levels, at least not for a more or less indefinite time. On the other hand, and this is actually the more important factor, the competition of gold is substantially hobbled by measures ranging from the total prohibition of private ownership of gold to refusals to enforce the terms of private contracts made in gold and subjecting gains from such contracts to rates of taxation high enough to take away the incentive to enter into them. Another major impediment to the government's prohibition, is the government's prohibition against merchants accepting gold coins at their bullion value rather than their face value. For example, you see on the screen, or will, excuse me?
There we go. There you
go. Okay, success. All right, what we see here is a conventional $20 bill, which I hope you're all familiar with. And here is a $20 gold coin known as a double eagle. This is the actual size of the coin. And I have an enlarged version just because I'd like you to see something else on it. Namely, right down here, if you can make it out, it says $20. $20. This is a piece of gold that contains approximately 1 ounce of gold, I think 9/10 fine. And the current bullion value, the current market value of this much gold is in excess of $400 right now. We'll assume it to be $400 for the sake of simplification. Now, just think of the implications of merchants being allowed to accept these gold coins in exchange for their goods and services, not as just $20. You see, today you could legally spend a $20 gold coin, but the merchant could only accept it as the equivalent of this $20 bill. But the market value of this coin is $400. Now, imagine that the merchants could accept it at its bullion value of $400. So here you are. Imagine you want to buy, say, an Apple iPod with some accessories. That should add up to about $400. And one way to do it would be you could put $400 on your credit card, or maybe you have $400 in currency. Or another way would be you could plunk down a $20 gold coin. Now, this, I think, would teach an incredibly important lesson, that here's something that's $400 in the paper and $20 in the gold. Now think, what about a new $20,000 automobile? If the automobile dealer could accept gold coins at their bullion value, well, you count out 5 of these at $400 each, that's $2,000. Count out 50, 10 times more, that's $20,000. You have 50 of these $20 gold coins. Each one says $20. Well, that's $1,000 in gold coin is buying you the $20,000 automobile. $10,000 in gold coin buys you a $200,000 house. Now, suppose people had experiences such as this in their day-to-day transactions, and the same thing with the old silver coinage. Then it might start dawning on them, yeah, prices have really been rising, but they've been rising only in this paper money. They haven't been rising so much, maybe not even at all, in the gold. Well, which money would you want to have? Which would you want your pension payable in? Which would you want a lease agreement payable in? Any future obligation. There would be an incredible demand for gold that would be based on people's observation in their day-to-day experience that the rise in prices was in the paper money. And they would start to think, you might even begin to think, well, what I mean by $20 is not this piece of paper. What I mean by $20 is this ounce of gold. That's $20. This $20 piece of paper, that's equal to $1 in the gold. This $20 note is equal to 1 gold dollar. A paper dollar is 5 gold cents. And then people might start thinking, well, the reason that prices are rising is we're expressing prices in cheapening paper money. Now, the rapid increase in the quantity of paper money, the extent to which it increases more rapidly than the supply of gold, that is the fundamental feature of inflation. It's the fact that the government, in controlling, in having first substituted paper for gold, and now can increase paper as rapidly as it likes, to the extent it starts increasing it more rapidly than gold, that is the whole root of the problem of inflation. It's the explanation of generally rising prices, of debtors gaining at the expense of creditors, of exchange rate depreciation, and of every other feature of inflation. A gold money, in contrast, even though it too serves to increase spending, would probably not raise prices, because the modest increase in its quantity would most likely be within the limit of the increase in the production and supply of ordinary goods, with the result that most prices would probably fall as they did over the course of the 19th century. The best definition of inflation is precisely, I think, an increase in the quantity of money in excess of the increase in the supply of gold. And this definition, incidentally, can be found in Rothbard's Man, Economy, and State, and as far as I know, is original with him. I consider it a very important contribution. An enormous difference between gold money and irredeemable paper money, which von Mises identified, is the radical difference between them with respect to the relationship they engender between the citizens and the government. Gold money makes the government financially dependent on the citizens. Irredeemable paper money makes the government financially independent of the citizens and makes the citizens financially dependent on the government. Under gold money, whatever funds the government may possess at any given time leave its possession and enter the pockets of the citizens, who produce everything the government buys. To continue its operations, the government must regularly turn to the citizens for fresh money. It cannot obtain the gold it needs from any other source except the citizens. It is financially dependent on them. And the result is that every act of government spending is easily perceived as imposing a corresponding burden on the citizens. Every proposal for increased government spending in such circumstances represents an equivalent threat of increased taxes, with the further result that such proposals encounter strong resistance and are likely to fail. A policy of government budget deficits under a gold standard is not an option. Every year of deficits increases the government's interest burden while doing nothing to increase its revenues. Indeed, a mounting public debt under a gold standard brings with it the specter of default and results in the withdrawal of capital and gold from the country and a reduction in the volume of spending and revenues in that country, including, of course, the government's tax revenues. The consequence is that all but the most reckless, irresponsible governments are compelled to operate with balanced budgets, which places them under the necessity of providing for all government expenditures out of current tax revenues. But under irredeemable paper money, conditions are entirely different. The ability to create such money gives the government a source of funds that does not depend on the citizens. The government now has its own independent source of funds, the printing press. In these circumstances, proposals for increased government spending do not appear as constituting any kind of direct threat of increased taxes. The government is perceived as standing outside the economic system, free of the financial constraints that still apply to all the individual citizens. It can finance additional spending without raising taxes, for it now has its own independent source of money, the printing press. This transforms the character of political debate and results in an unchecked increase in government spending and government activity. The cost of new government programs no longer appears as a reason for rejecting them because the connection between their cost and higher taxes has been broken. Political debate now proceeds with the supporters of the programs enumerating their benefits to this or that group, and the opponents appearing to have no basis for their opposition other than some form of inherent naysaying or misanthropy. In just this way, the so-called liberals, the interventionists and socialists, appear as the enlightened friends of mankind, while their conservative opponents are made to appear as heartless enemies of human well-being. And it's on this foundation that the president is graciously giving us a prescription drug benefit. He's giving it to us. Well, what makes an illusion like that possible? It's that the government has its own printing press. And things even go further. People are led to the belief that instead of them supporting the government supports them. Because it now is in fact the case that people get their money from the government. And we have a situation where it appears that not only is there a free lunch that the government provides, but that those who are providing the free lunch are thereby enabled to have a free breakfast and dinner. This is the miracle of the Keynesian multiplier. And an important manifestation of this mentality is the belief that Washington, a city devoid of practically all actual production, a city populated by hardly anyone but bureaucrats living on goods produced elsewhere, while doing almost everything in their power to hamper economic activity everywhere, that they can somehow bail out other economically far more important cities such as Detroit, Cleveland, St. Louis, or New York. Indeed, bail out entire states and regions and the entire rest of the country. What permits this delusion is the fact that Washington is where the irredeemable paper money originates. Now, among the effects of the increase in irredeemable paper money, as I indicated in my discussion of capital accumulation, it undermines capital accumulation by making it impossible to replace assets adequately. That undermines the productivity of labor, which undermines the general standard of living. And it's in this way that on the one side, the apparent miracle of free benefits is accompanied by mysterious costs that appear out of nowhere. There are people having a harder time making ends meet. Things are going bad, but they don't see the connection between the financing of the free benefits and the causation of the costs. And so the public does not understand the consequences of the government's inflation and instead blames those consequences on the greed of profit-seeking businessmen. It looks at the sharply increased paper profits accompanying rising prices and takes that rise in profits as proof of the businessmen's responsibility for the rise in prices. The usual definition of inflation as rising prices also leads to this conclusion. For if inflation really were rising prices, then it comes into existence only in the instant in which businessmen raise them by ordering the posting of higher prices on store shelves or in sales catalogs. The ignorant public then turns to the government, which it already views as Santa Claus and the Tooth Fairy, for protection from what it perceives as the malicious evil of the businessmen. It demands price controls. Now, I want to conclude this lecture, since I am a little pressed for time here, by explaining how inflation is the underlying cause of the business cycle and of deflation. What is involved here is not a direct expansion of money by the government, but a government-sanctioned and government-sponsored process of inflation that von Mises calls credit expansion. Credit expansion is the creation and lending out of newly created money, typically by private banks. It centers on the creation of what von Mises calls fiduciary media. To understand fiduciary media, it's first necessary to understand the concept of standard money. Standard money is money which is not a claim to anything beyond itself. When you get it, you have been fully and finally paid. Under a gold standard, all the gold coins and gold bullion, that's standard money. There could be gold certificates. There were gold certificates. The gold certificates were paper notes which were claims to the payment of standard money on demand. They were not standard money. They were a claim to the standard money. Today, under our system of irredeemable fiat money, this sort of stuff is the standard money. When you've gotten this, you have been paid. It's not a claim to anything beyond itself. A checking deposit, in contrast, is not standard money. It's a claim to standard money. The nature of a checking account is you have a claim against the bank. The bank is supposed to pay you this sort of stuff as and when you demand it. So it's a claim to standard money. Well, fiduciary media, what fiduciary media are, they are transferable claims to standard money, above all checking deposits. They're transferable claims to standard money, payable on demand by the issuer. So you just ask for your standard money, they have to pay it. But they're transferable and they're accepted in commerce as the equivalent of standard money, but for which no standard money actually exists. In today's conditions, fiduciary media can be understood as the totality of checking deposits insofar as they exceed the bank's reserves of standard money. The banks have some significant amounts of standard money in their vaults. They also have some in the form of deposits with the Federal Reserve banks. At present, in the United States, checking deposits in one form or another amount to approximately $2 trillion. And you might even argue that they're substantially higher than that. The reserves of standard money behind these $2 trillion of checking deposits are about $44 billion. Thus, the presently outstanding magnitude of fiduciary media in this country is approximately only $44 billion less than $2 trillion. So that's $1.956 trillion. It's a fractional reserve of 2.2%. Now, reserves relative to checking deposits have never been as meager as they are now. What allows the present situation to exist is only the ability and willingness of the Federal Reserve System to manufacture new and additional standard money to whatever extent is necessary to maintain the solvency of the banking system. The existence of fiduciary media is what creates the potential for deflation. That is, the literal wiping out of money and a consequent reduction in the volume of spending in the economic system. This is because the overwhelming backing for fiduciary media is debt. the debts incurred by borrowers when the banks grant them loans consisting of fiduciary media. Whenever anything happens that causes a significant inability of debtors to repay their debts to banks, there's a corresponding reduction in the assets of the banks. Every such reduction threatens the ability of the banks to honor their fiduciary media. A mere 5% reduction in the assets of any given bank may be enough to reduce its overall assets below the level of its outstanding deposit liabilities. And this would be true even if the banks held much larger reserves than they do now. As soon as this situation is perceived to exist, we have the potential for a run to commence against that bank. And in the old days, before the Federal Reserve would shovel carloads of new money to meet the withdrawals, you'd have runs. Those who get there in time, they're paid off. The bank runs out of its cash. The other depositors get nothing. And their deposits, which up to that time had been the equivalent of money, lose their character of money, and now they turn to the status of junk bonds that have failed. They're junk bonds in bankruptcy. So you went to sleep Sunday night, you had a checking account at a bank, you thought you had so much money, you wake up to read Monday morning the bank has failed, your checking deposit is now of the status of a junk bond, no one will take it from you. So there's an outright reduction in the quantity of money. And if we think in terms of the quantity theory of money, this is the base of a decline in spending, a decline in sales revenue, a further decline in the ability to pay debt, more business failures, more bank failures, and the entire system has the potential to unwind. And that is exactly what was in process in the period 1929 to 1933, because we had a fractional reserve gold system where the fraction of gold was getting smaller and smaller in the system, and in 29 the whole system started to unwind. Now I don't know how this has happened, but by my watch I've only got 5 minutes left, so instead of attempting to cram any further bits of information down an already overloaded set of receptors, let me throw the floor open to just a few minutes of questions, and I'll be glad to try to answer them. Yes?
Is it actually legal, sir, to buy things in, I think in American coinage, where the vendor won't take more than $20 for it, but what happens if it's privately minted? Is that still legal to do that?
Suppose you offered a merchant an ounce of gold. I don't think you'd be able to do that. I have to consult the law, but I doubt very much that you'd be able to do that. Like for example, you say privately minted, all the gambling casinos in Las Vegas have chips, but you cannot use their chips except at their gaming tables. But you could not, by law, go into the restaurant of a gambling casino where you had purchased their chips and pay your check with their chips. The government is very jealous of monopolizing money for its own paper. Yeah.
First off, there is such a currency called the Liberty Dollar that is legal and current. It's not, legal tender, but it is money.
Where is it money?
Anywhere people accept it, it's legal.
Are there taxes on it?
Well, I would doubt that very much for the reason of these chips.
Norfed.org.
Pardon me?
Norfed.org.
Okay. There's a question back here, yeah?
Well, where do you think we're headed? In other words, what's the scenario in which you see that this system would collapse?
Well, anything that places sudden, new, and additional monetary demands on the government. The war in Iraq is a factor. This prescription drug benefit is a factor. I don't know that either of these or the two together, I don't think they'll result in a collapse, but there are some clear indications that inflation is becoming a more significant problem than it was a few years ago. So I'm not looking for a quick collapse, but incremental worsening of conditions. Yes?
So are you suggesting a government-mandated 100% reserve system?
Am I suggesting a government-mandated 100% reserve system? I think that would actually be legitimate and the basis for arguing for it, I think, is provided pretty well in Rothbard. If you see the fractional reserve system as representing an act of fraud, for example, is it mandated that if people bring goods into a warehouse, that the warehouseman not sell the goods or he not lend them out, that he retain them? Now, if checking deposits are warehouse receipts for money, you see, I think it would be legitimate to require that the banks ask their customers, are you, the customer, lending us this money, or are you asking us to hold it for you? If the customer says, well, we're lending it to you, then the banks should be able to lend it. But if the customer is saying, I expect that you're holding this money for me, they should not be able to lend that. And that would be the distinction.
But the expectation is now among any educated person that, that it's a loan.
Well, see, that's not all that clear. They know in a sense the bank lends the money, but when you get a check, you're also thinking that you're paid. You see, here you are. Suppose I say, okay, I owe you such and such money. Okay, now I'm finally paying my debt. I'm writing you a check. Well, I think that's a significant difference between my saying, yeah, well, I'm going to continue owing you this money. I'll owe you this money forever. You're never actually going to get paid. Well, you see, when you have the fractional reserve checking system, if you say you're getting claims to loans, then you're not actually being paid. So if people are really going to be fully and finally paid, they shouldn't be getting credit instruments. Yes, in the back over there. Yeah, you sir. Yes.
Well, in your previous statement, you said that if a person is just getting access to the loan, doesn't it still serve the same purpose of money that you outlined earlier in the lecture, that you can exchange it for other goods that you desire, as such becoming, we use the term fiat money?
Yeah. But when you get newly created money out of thin air, you haven't had to produce anything to earn that money. You're getting money which enables you to obtain goods and services in competition with other people who will tend to get less goods. You'll be getting goods at the expense of others who have an earned right to them, and you're getting them by virtue of just printing money. So you're taking out without having to put in. That's the difference. Yes, sir.
Yeah, in regards to fiduciary media, being responsible for deflation, for example, in the Great Depression, a lot of people would argue that the FDIC has pretty much eliminated the incentive for people to run a bank. And obviously, we could answer that, more government intervention solves problems caused by government intervention.
Okay. The FDIC is really not what stands between us and bank runs. We had the FSLIC, which was the Federal Savings and Loan Insurance Corporation, which was to that as the FDIC is to the commercial banks. They were totally wiped out. The FDIC could be wiped out with the failure of one large-sized bank, probably. They have a limited reserve of government bonds. What really stands between us and a collapse of the fractional reserve banking system is the Federal Reserve System's ability to create unlimited quantities of new and additional standard money. So we don't have the runs only because there's unlimited amounts of currency available or quickly to be made available that would satisfy those.
But assuming, and this is a pretty broad assumption, but assuming a benevolent chairman of the Fed or a benevolent inflationary policy, deflation would not only be taken care of, but would, if inflation wasn't a risk, then we wouldn't have either. Right?
I would say we really do not have, I don't think there is any serious risk of any significant deflation, because immediately they would inflate, and they just did. We were headed toward deflation in 2002, and then they reversed course. But then they reversed course, and the problem is that now we have a more serious problem of inflation. We keep ratcheting up in higher and higher prices, lower and lower values of money.
George, we're out of time. Thank you very much.
Okay, well, thank you.